Hi, good evening, everybody. Today I'm going to talk about a topic which is easily one of the most critical topic, I believe, in the mutual fund or pooled fund management industry, but also the one which is probably the least discussed. That's about the portfolio liquidity. And I basically am going to talk to you about why you should not ignore portfolio liquidity and why it is so critical. If I have to draw a parallel of portfolio liquidity, I would say that it's like, our vital body parameters that we generally tend to ignore till things go wrong with us. Unfortunately, over the last few years, we have seen investors and distributors waking up to the importance of portfolio liquidity rather late after an accident has happened. And by that time, the damage is already done. So let's get straight into portfolio liquidity. Now, the word liquidity, as you know, in financial services industry is used in different contexts and people mean different things by liquidity. So companies and banks may use liquidity for a completely different reference. Today, I'm referring to portfolio liquidity, uh, essentially for an ability of an investment manager to meet redemption in his fund, and this is true for mutual fund or any pooled investment, to meet redemption in an orderly fashion without compromising the interest of investors who are not redeeming. And that's a very, very important part. And I will come to the mechanics of how things go wrong shortly. As I said, in good times, investors and distributors tend to take liquidity for granted. However, we all know that particularly people who have spent years in the market know that good times don't necessarily last and bad things or accidents can happen and do happen. And therefore, it's important to understand this very well. Now, what are the root causes of liquidity related accidents? And frankly, liquidity related accidents we have seen happening in all markets. I think that is one of the important aspects of investment field, that if you don't focus too much on liquidity, accidents could happen. But at the core of these accidents, there is a mismatch between liquidity available to investors in a pooled fund and the underlying liquidity of the asset class. So the rate at which the money flows into a pooled fund is, if it is not in consonance with the underlying liquidity available in that asset class, there is a problem. And why does this happen? This happens because capacity constraints of a strategy are often ignored. People tend to get carried away and they allow their funds to become too big for the underlying asset classes. And when this is happening, typically it is also, accompanied by very good performance, which sucks in more and more assets. However, it creates pockets of illiquidity in that fund. And therefore, the fund becomes vulnerable or risky if any accidents were to happen. So the next slide, I'm basically going to talk through how things could go wrong if liquidity is overlooked. Typically, the trouble starts with adverse circumstances in the asset market, often due to exogenous shocks. The shock could come from geopolitics, shock could come from some action by the regulator, it could come from anywhere. So when that happens, when trouble starts, the underlying liquidity of the asset class starts to dry up. And we have seen this if I'm sure participants recall 2018, how the liquidity kept drying up in the equities market. So liquidity tends to dry up. Also, within that, if the quality of the security is poor, the liquidity shrinks even further. And as a result, the bid-ask spreads widen. So if in troubled circumstances, if you want to sell a low quality security, you will not easily get a bid for that. So bid-ask spread widens. If a proportion of such low quality securities is high in the portfolio performance starts to deteriorate. And when that happens, alert investors or smart investors rush for redemptions from that fund. Now, in these circumstances, if the redemptions come in a big way, investment manager is typically forced to sell what he can not what he wants to. So he may want to sell his lower quality illiquid securities, but there are no buyers. So he's forced to sell his better quality liquid securities to meet redemptions. When that happens, the consequence of that is that the residual portfolio quality and liquidity worsens further. As a result of which, the remaining investors who did not redeem, I think their interests are severely compromised. So the performance suffers, and the outcome can be even worse. Now, what I just explained to you is not theoretical. I'm sure each one of you have experienced such episodes, both in the equities market as well as in debt markets recently. So this is how things could go wrong if the liquidity is overlooked, and the consequences for investors who did not redeem can be very, very dire. After explaining this, let me just briefly touch upon, I'm going to leave a lot of time, I think, for Q&A, but let me just touch upon how we think about liquidity as far as our portfolios are concerned. So one most important thing is we think about liquidity at the design stage itself. When we devise a portfolio, we obviously think about the attractiveness of that particular stock and how much to own it, sizing of bets. But liquidity is another consideration that we keep in mind from the start. It's not an afterthought for us. As a consequence, we try to balance the importance of both performance and liquidity for the long-term interest of all investors. When I say all investors, I'm referring to the earlier comment that I made, that liquidity is an ability of an investor to meet redemptions in an orderly fashion, so as to also take care of investors who are not redeeming. So you have to balance the performance aspect and liquidity aspect of the portfolio together. Thirdly, obviously, circumstances keep changing. So you have to monitor the liquidity, underlying liquidity very carefully and make any adjustments if required. So ultimately, what is the objective? The objective is not to be forced to change the complexion of the portfolio to meet redemption. What I explained in the vicious cycle for redemptions leading to performance deterioration, leading to further redemption. So you should never be forced to change the complexion of the portfolio, which is really the most fundamental point. Now, let me come to my concluding slide, which is, what we will urge you to do or advise you to do is to make, I know that, many of investors and also their advisors tend to look at past track record of a fund manager, brand name, and many other aspects while choosing a particular mutual fund. I would strongly urge you to make liquidity also as an integral part of your checklist that you have for recommending a fund. I would say that it's an absolutely must for small cap and mid cap mandates, because inherently, as you know, small cap and mid cap segments of the market are less liquid compared to large caps. But I would say it is also important to focus on liquidity for large sized multi-cap and large and mid-cap kind of mandates also, because there are elements of small cap and mid-caps in that. Third point is it's very, very easy to compute from publicly available information this particular data. So if you have an internet connection, in 10 to 15 minutes, you will be able to find out these liquidity measures for any fund. So you can look at the fact sheet, you can look at the trading. So how you would do it is basically look at the average trading volume of a particular security. You can look at maybe last 3 months or 6 months moving average. The number of stocks in the portfolio. And thirdly, you have to assume some participation rate from an impact cost perspective. So you can take 20%, 30%, whatever is your liking. And from that, you can find out how much time it will take the fund manager to liquidate that particular security. So it's very, very easy to compute from publicly available information. And I would urge you to use it not so much as an absolute measure, because depending on your assumptions, the absolute number might change. But with the same assumptions, you can use it as a relative measure. So you can compare across funds using certain levels of average, moving average 3 months, 6 months, or participation rate of 20 to 30%. So it should be used more as a relative measure. So I just want to end saying that in good times, it will not matter much, as we have seen, but we know that it's better to take preventive action first rather than rush to a hospital in an emergency, as we have seen in the recent episodes. Thank you very much. And if you have any further questions on liquidity, please do reach out to your relationship manager from Edelweiss Mutual Fund. Thanks a lot.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.